All right, let's get ready for this deep dive. You sent over some excerpts about investing.
Yeah.
And I gotta say, this idea that amateur investors might actually have an edge over the pros, that's pretty intriguing.
It's a pretty fascinating concept, yeah.
Yeah.
I mean, we often just assume, right, that the professionals, they hold all the cards.
Right.
But the source material here makes a really compelling case for how sometimes simplicity,
Yeah.
and a long-term mindset, those
Yeah.
can actually outperform these really complex strategies.
Yeah, that's what really stood out to me too. Like the excerpt suggests that everyday investors, free from all the pressures of Wall Street and everything,
Right.
they can actually leverage their position kind of for better outcomes.
Mm,
Almost like they're playing a different game entirely.
absolutely. The source kind of dives deep into this idea by looking at several key advantages that amateur investors might have.
And one of the first things that jumped out at me was this emphasis on the power of simplicity,
Right.
particularly with tools like index funds.
Right, right, right. And the source makes this pretty compelling point about how the nature of index funds, they align perfectly with a long-term approach.
Yeah.
Instead of trying to pick individual winners and losers, it's like you're investing in the overall growth of the market.
It's like betting on the entire economy to keep moving forward,
Right.
which historically has been a pretty good bet.
Yeah.
But, the source also sheds light on this kind of rather sneaky practice, I guess you could say,
Mm-hmm.
amongst some professional investors.
Yeah.
These so-called closet index funds.
Oh, yeah. The wolves in sheep's clothing.
Yeah, exactly. Have you ever even heard of this term before?
Yeah.
Like, what comes to mind when you hear that closet index funds?
Oh, totally.
Yeah.
Yeah. It's a new one for me, I think.
Yeah,
It sounds a bit deceptive, though, right?
it does. Yeah, like something hiding in plain sight.
Yeah, exactly. Essentially, these are funds that are managed to mimic the performance of a, well-known index fund, like the S&P 500.
Okay,
But here's the catch. They charge significantly higher fees.
hold on. So investors are paying a premium for something they could get much cheaper elsewhere.
Exactly.
That just doesn't seem right.
And even more concerning, this practice seems to be on the rise.
Oh, wow.
The source cites a study by Lazard, the investment bank,
Mm-hmm.
showing a growing trend of these closet index funds right here in the U.S.
It's almost like they're trying to capitalize on people's unfamiliarity with the nuances of these financial products.
Mm-hmm.
But what really stood out to me was how this all ties into this idea of conformity in the financial world.
Oh, yeah.
The source recounts this fascinating anecdote about Peter Lynch,
Wow.
the legendary fund manager,
Yeah.
that perfectly illustrates this point, I think.
Oh, that's a great example. It highlights how even the most successful investors, right, can fall prey to this pressure to conform.
Right.
And it involves two company presidents whose pension funds were being managed by the same bank. And it really reveals how fear can drive decision-making.
So was one of the funds performing better than the other?
Yes, but here's the twist.
Okay.
Both funds were actually doing quite well.
Wow.
But instead of just letting the winning strategies continue,
Yeah.
the bank, feeling the pressure to maintain a sense of uniformity, decided to homogenize their investments.
Wow.
Basically, they eliminated those unique approaches that were driving the success.
So in an attempt to avoid standing out, they ended up diluting the effectiveness of their own strategies.
Exactly.
They basically created a closet index fund, only with even less potential for growth.
Precisely. And it all stems from this fear of being different,
Mm.
even when that difference is yielding positive results.
It makes you wonder, why would professionals, especially those at the top of their game, be so hesitant to deviate from the norm,
Right.
even when it's working in their favor?
The source argues that it boils down to this immense pressure to keep up with their peers.
Right.
And the fear of standing out, even if it means sacrificing potentially superior strategies.
Like they're trapped in a system that prioritizes appearances over actual results.
And this brings us to this compelling case study that the source uses to showcase how this pressure to conform can lead even seasoned investors astray.
Mm-hmm.
The dot-com bubble.
Ah, yes, the dot-com bubble.
Right.
A classic example of how herd mentality can take over.
Mm-hmm.
Even in the face of, warning signs, it felt like everyone was jumping on the internet stock bandwagon back then.
You're right. And the source highlights this particularly insightful contrast.
Okay.
Warren Buffett,
Oh, yeah.
known for his value investing approach, resisted the dot-com hype,
Right.
even when facing criticism for his contrarian stance.
Now, for those who might not be familiar, can you explain what value investing means in this context?
Sure. Value investing, in essence, focuses on identifying companies that appear undervalued by the market.
Mm-hmm.
It's about looking beyond the hype and focusing on a company's intrinsic worth, its fundamental value. During the dot-com bubble, a lot of investors were swept up in the excitement of, new internet companies,
Right.
often disregarding traditional valuation metrics.
So while everyone else was chasing the next big tech IPO,
Right.
Warren Buffett stuck to his principles.
Yeah.
Even though it meant going against the grain, it must have taken a lot of, I don't know, conviction to stay the course during such a frenzied period.
Indeed. And it's like a perfect illustration of how independent thinking, even when it's unpopular, can ultimately lead to better outcomes.
Right.
When the dot-com bubble burst, Buffett's patience and adherence to his value investing philosophy paid off while a lot of others faced substantial losses.
It's a powerful reminder that sometimes the smartest decisions are the ones that challenge the status quo.
Absolutely. And this is where the source begins to unpack this truly intriguing idea
Okay.
that individual investors, unburdened by the constraints and pressures of the professional world, might actually possess this unique advantage.
This is where it gets really interesting. Yeah. Tell me more about this advantage. How does the source explain it?
Well, the source argues that individual investors, unlike their professional counterparts, they aren't bound by the same pressure to conform to industry trends or chase these, fleeting gains. They have the freedom to be patient, be independent, and make decisions based on their own assessment, not the dictates of a boardroom or anxieties of clients.
So they're not constantly looking over their shoulder, worried about getting fired for not following the herd.
Exactly. They can learn at their own pace, delve into research, and explore strategies without having to justify every move to a supervisor or, appease a client demanding those immediate results.
That makes a lot of sense. The source really emphasizes how individual investors don't need to prove their abilities to anyone, which can be incredibly liberating, I imagine.
It is. This freedom allows them to focus on what truly matters, their own long-term financial goals. They can play the long game, ignoring the short-term noise that often distracts professionals.
It's almost like they're playing a leisurely game of chess while the pros are caught in this frantic game of speed checkers.
That's a great analogy. And the source contends that this long-term perspective, combined with the ability to resist the pressure to conform, can lead to surprisingly effective results.
But doesn't this approach also require a certain level of, discipline and knowledge? I mean, navigating the financial world, even at a leisurely pace, can be pretty daunting. Are there pitfalls that individual investors might stumble into as well?
Absolutely. No investment strategy is foolproof. Individual investors certainly face their own set of challenges. However, the source suggests that by embracing simplicity, patience, and independent thinking, amateur investors can potentially mitigate some of the risks that professionals often succumb to.
So it's not about being smarter than the pros. It's about approaching the game with a different mindset, one that prioritizes personal goals and long-term vision over, fleeting trends and the pressure to conform.
Precisely. And it's about understanding that sometimes the most straightforward approach, coupled with long-term outlook, can yield surprisingly effective results.
This less is more approach to investing is starting to really resonate with me. It's like taking a step back from the frenetic energy of the market and focusing on the fundamentals.
That calm, reasoned perspective can be a powerful asset in the often emotionally charged world of investing.
This entire conversation has been incredibly eye-opening. It really flips the script on who has the upper hand in the investing world.
And it's important to remember that this isn't about blindly putting all your money into index funds, right?
Right?
It's about understanding the core principles that the source highlights.
The principles of simplicity, patience, and independent thinking.
Exactly. And by embracing these principles, individual investors can potentially navigate the market with greater clarity and confidence.
But I'm curious, the source primarily focuses on the advantages that individual investors have. Are there any downsides to this approach? Are there situations where professional expertise might be essential?
That's a great question, and it's something that the source doesn't explicitly address. However, it's safe to say that there are certainly complex financial situations where professional guidance could be invaluable.
Like navigating estate planning
Exactly.
or managing a large inheritance.
Exactly. or perhaps dealing with the intricacies of international investments or sophisticated tax strategies. However, even in those situations, the principles of simplicity, patience, and independent thinking can still serve as valuable guiding lights.
It's like having a solid foundation, regardless of the complexity of the structure you're building on top of it.
That's a great way to put it. And it emphasizes the importance of continuous learning and self-education. Ultimately, the most valuable investment you can make is in your own knowledge and understanding of the financial world.
So even if you're not a professional investor, you can still empower yourself to make informed decisions that align with your personal goals and circumstances.
Absolutely. And that's perhaps the most empowering takeaway from this entire deep dive.
This deep dive has really been like a revelation. It's made me rethink so much of what I thought I knew about investing.
Yeah, it's amazing, isn't it, how deeply ingrained some of those assumptions are. Like, we tend to equate complexity with effectiveness,
Right,
especially in fields like finance.
right.
But what we've been talking about today suggests that sometimes a simpler, more grounded approach can actually be the key to success.
Yeah, it's like that saying, the best things in life are free.
Yeah.
Maybe the best investment strategies are the ones that, free you from the constraints of conventional thinking.
I like that. And it ties back to one of the core principles we've been discussing, right? Independence. Individual investors, they aren't burdened by this need to please clients or keep up with industry trends. They have the freedom to chart their own course.
Speaking of charting our own course, this whole conversation has me thinking beyond just the world of investing. Do you think these principles of simplicity, patience, and independent thinking, could they apply to other areas of life as well?
Hmm, that's a really interesting question. And while the source material doesn't explicitly address that, it definitely opens up a whole new avenue to explore. Like, could this less is more philosophy be just as effective in our personal lives or our careers or even our creative endeavors?
It's a pretty thought-provoking idea, right? Maybe by simplifying our approach, focusing on the long game, and trusting our own instincts, we can unlock a deeper level of, success and fulfillment in all aspects of our lives.
Yeah, it's definitely something worth thinking about. Perhaps the real lesson here isn't just about picking the right stocks or funds, but about cultivating a mindset that empowers us to make clear, confident decisions no matter what the challenge or pursuit is.
Wow. That's a really powerful takeaway. This deep dive has been a real eye-opener, challenging conventional wisdom and offering a fresh perspective on how to navigate not just the financial world, but maybe, life itself.
What's important to remember is that this isn't about just blindly following index funds.
Yeah.
It's about understanding that core principle.
Yeah.
Sometimes, the most straightforward approach, combined with a long-term perspective, can lead to surprisingly effective results.
So what does all this mean for you as an investor? The source material doesn't touch on this directly, but it made me wonder, could there be other areas of life where this less is more approach could be beneficial? Food for thought.